US stocks broadly are poised to deliver returns that are unattractive to investors, uh, given their risk profile. We think that there are pockets of US equity markets and equity markets across the world that are poised to give normal, if not above average, returns for bearing equity risk.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Jeremy Grantham is one of the most respected investors alive today. His firm, Grantham, Mayo, Van Otterloo Company, better known as GMO, manages billions in assets under management and produces some of the most followed market analysis on Wall Street. Core to its outlook is that financial and economic extremes will mean revert, and that prudent investors can proactively position themselves to benefit greatly from that reversion when it takes place. And while no, I'm not interviewing Mr. Grantham today, we've got the next best thing, the chance to sit down with one of his lieutenants at GMO. John Pease is a quantitative researcher and partner at GMO who co-authored the firm's latest quarterly letter, which I expect to discuss with him in depth. John, thanks so much for joining us today.
Thank you for having me, Adam.
Hey, it's a real pleasure, John. As I mentioned when the cameras were off, that the work done by GMO is highly respected by so many investors, but particularly so by myself and the financial advisors who join me every week on this program. Hardly a week goes by where we don't reference GMO in some way, shape, or form. So it is an absolute privilege and pleasure to have you on the program today.
Very kind of you.
Oh, all right. Well, look, this should be really fun. Let's see, I've got a bunch of questions here from your latest quarterly letter. But before I get to those specifics, if we can, I'd like to start these conversations, John, off at a very high level. What's your current assessment of the global economy and financial markets?
So the global economy broadly and the US economy in particular have transitioned over the past 18 months from being very overheated with extremely tight labor markets to seeing a meaningful slowdown in economic activity and to seeing labor supply and labor demand coming into much better balance. There's this Fed report called the Beige Book that I think illustrates this really well. That report collects anecdotes from businesses across the US economy on the ground. And in March of 2023, this report had this anecdote of a Montana construction firm that was having such a hard time finding workers that it was actually having to rent out a private jet to fly workers into its construction sites. That's how overheated the economy was. That's how tight labor markets were. If you look at the most recent iteration of this same report from July of this year, what you have are many anecdotes of labor supply actually surprising to the upside. You have lots of firms talking about being surprised at the number of applicants they're getting per job opening. And so we have seen a slowdown. And in part, that's good news. That's exactly what the Fed wanted to engineer when they started raising interest rates. They wanted to bring down economic activity, to slow it down, excuse me. They wanted to bring the labor market into better balance. And again, they needed to do this in order to cause wage inflation to come down so that overall price inflation in the economy was going to come down as well. Now, the question, of course, is whether we're going to stop at a slowdown or whether we're going to go to a downright contraction of the economy, of a recession. And before I talk about our view on financial markets writ large, I think it's worth making 2 points on recessions. The first one is that when you are investing in equities, the reason you are getting compensated for that investment, the reason you are making a risk premium over cash is because you are taking that recession risk. You are underwriting an asset whose return is generally poor during times when the economy is doing poorly, when money is really valued. So if you are going to invest in equities on the back of guessing whether a recession will occur or not, or excuse me, estimating whether a recession will occur or not, you had better get it right. If you were to invest in equities in a month when a recession was happening, generally you would lose about 1.5 percentage points. If you were to invest in equities on a month when a recession wasn't happening, you generally make around half of that. So you get to be wrong 2 out of 3 times if you're investing on the back of guessing whether a recession is happening or not. And many economists don't do a phenomenal job um, telling when a recession is coming. If we look back at 2023, over 60% of economists polled by Bloomberg actually expected that a recession was going to occur. A recession did not occur. If you didn't invest in equity markets back then, depending on where you invested, you forewent from anywhere between 10% returns outside of the United States to 25% returns in the S&P 500. So there is a cost to not investing in equities. Now, that isn't to say that we're particularly sanguine on US equities broadly today. We aren't. There are pockets of the US market where we think we're getting compensated for holding risk. One of those is a structural portion of the equity market, which are quality companies, high quality companies in the US. When I say high quality, I mean companies that have high and stable profitability and that have very solid balance sheets that don't carry a lot of leverage. Now, these companies have generally delivered equity-like returns over the long run while experiencing only 2/3 of the downside of the broad market during a correction. That's as close to a free lunch as you're going to get in equity markets. You may say, well, if the broad market is down 60% and my quality holdings are down 40%, does that really matter? When you think about that from the perspective of somebody who's down 60%, who needs to see a 50% rise in their assets in order to reach those quality companies, it does. It really can make a difference. So we think that if you can find quality companies that are not overvalued, and there are some in the market that are, you can do a very good job by investing in those, and you can sleep well at night. That's what our quality fund, what our quality ETF try to do, and they've had a long track record of success. Then there is this more tactical opportunity in US stocks, which comprises the cheap quintile of US stocks. So what we call the deep value stocks in the US. These are always companies that trade cheaper than the broad market. What's unique about them today is that they are trading at a much wider discount than they usually do. These companies have traded at a multiple that is now at the 10th percentile of its discount over history. And that means that they're likely to have better forward-looking returns than they've had in the past. So these are companies that we estimate could have 7% real returns in our asset class forecasts going forward. That's a pretty good return for equities in general. And if we look at deep value outside the United States, we are particularly optimistic on those stocks. Not only are those companies trading at a much wider discount than they normally trade, but when you invest outside of the US, you also get this benefit from currencies being cheap. And cheap currencies tend to be a tailwind for equities, whether those currencies come back to fair value or not. Our co-head of asset allocation, Ben Inker, wrote a piece back in 2021 or 2022, I believe, where he was looking at how local equities did when a country's currency was cheap. And what he found was precisely that the local equities did very well whether currencies snapped back, in which case you got a windfall from currencies mean reverting, and when they didn't. And you can ask the question, well, why did they do well even when currencies remain cheap? And that's because local companies became more competitive versus the rest of the market. They could export at cheaper prices. They faced less competition from abroad locally. So all of that added to their profitability. But that's a long answer. Happy to take your questions.
That's a great answer. If I could try to summarize that, let me know if my key takeaways here are accurate. Um, when you started with what you so you talked about how you see things moving from a very overheated economy and tight labor market to a slowing economy, and we'll call it a normalizing labor market, though I do want to dive into that a little more deeply with
Yep,
you. Um, and one could look at the slowing economy and the quote unquote normalizing labor market and say, yeah, Fed's achieving what it decided to do. But if I look at the Fed's history, its tools are crude. It has more of a chainsaw versus a scalpel. And
absolutely.
and overshoot might be a real risk here. In fact, there's a lot of people already thinking, oh my gosh, the Fed has remained too high for too long, right? And if they
Mhm.
did, that kind of would be their pattern, right? Um, so if you're worried about recession risk, you start with the reminder that says, hey, equities have performed pretty well. But remember, one of the reasons why they do perform well in good times is you're getting that risk premium, right?
Exactly.
And remember, it's a risk premium. So that means that during times of recession, there's a risk discount that you're going to have to stomach as well. So one, just be aware that equities might not perform great going into a recession. But if you're going to keep an equity percentage of your portfolio going forward with this risk, you may want to look at shifting that composition more towards the high quality companies for the reasons that you mentioned, right? They tend to hang in there better and get hurt less.
Yep.
And then also increase exposure to the deep value companies, which may actually have a lot of appreciation potential going forward from here. I don't want to say irregardless of what the economy does, but
Mhm.
despite what the economy does, these things may have some mean reversion that's going to raise their prices. So looking at shifting composition of your whatever equity stake you determine to have, given the current recession risk, looking at those two cohorts seems to make a lot of sense right now.
Yes. And in the case of deep value, you can make that return in a couple of different ways. One of them is having that very wide discount at which those companies are trading snap back to normal. That doesn't
Mhm.
mean those companies are going to trade at the same valuation as the broad market. It just means that they're going to trade at a more usual discount than what they currently trade at.
Right, and sorry to interject, but that's classic GMO strategy, right? Something that is currently trading at an extreme, and you're just playing the mean reversion there.
Absolutely. But we aren't just playing the mean reversion. So even if we don't get that discount to shut, uh, we still think that value investors are going to make exceptional returns going forward. And the reason behind that is that despite these companies undergrowing the broad market, they generally more than make up for that undergrowth. And that's been true over the past 5 years, even through their income differential
Hmm.
and also through the fact that their prospects get reevaluated. It tends to be the case that companies go through something unfortunate or nasty over the course of their lives. You can take Meta as a recent example. It's a growth company, or it is usually thought of as a growth company. They were trading at relatively high multiples in 2021. Then they started talking about investing in the metaverse in scale. Investors starting getting worried about the amount of capital expenditure that they were going to deploy into that project and the fact that profits weren't going to be coming soon, especially in an environment where interest rates were going to be rising. And they really punished Meta's stock price as a result. Meta responded to this. Investors were discounting future cash flows as if there weren't this underlying marvelous business where they managed to advertise super profitably through their different platforms. But that business was intact. As soon as they began to cut costs, as soon as they said, no, wait a minute, we are going to deploy our capital expenditures a little bit more carefully than we had talked about in the past, the company soared. That was a deep value opportunity back then. In fact, we still think it is an attractive stock today. It's not necessarily a stock you would say, oh, I think of this as deep value normally, but it is the kind of stock where you are buying growth at a reasonable price, and to our mind, at a very reasonable price. And so that future being reevaluated, causing multiple expansion to happen, is generally the main way you get paid for holding deep value stocks. They are thought of as being stocks that are going to do poorly forever. And again, we have plenty of examples of this occurring today. Pfizer, after the pandemic became less salient and their pandemic-related products became less profitable, is a company that has seen its valuations fall and its prospects start being scrutinized in a way they weren't previously. Now it is trading at an attractive valuation. So we believe by finding this kind of company and by investing in it systematically, you end up putting yourself in a position to really benefit, not just from the fact that overall these companies are trading at too cheap a price, but that as soon as their prospects get reevaluated, these stocks tend to migrate up to growth cohorts, and their multiples tend to move a lot as a result.
So let me ask you this. There's the old saying about manias, that men lose their mind at once, and they regain their sanity one at a time. Are these deep value stocks, are they kind of like the inverse of that, where the stocks fall out of favor, and they're mispriced, and then there's something that causes the market to wake up to like a sector, and they all come back at the same time? Or is it always just individual stories? Company falls out of favor, it's underpriced, and then there's some trigger about that specific company that brings it back into favor here. I guess what I'm asking in your answer here is, looking at ahead, given the outlook you've just given us, if you're buying deep value now, are you expecting kind of deep value as a category to do better going forward, or is it going to be deep value as an individual basket where you're just going to have these guys kind of hopefully popping over time back to a truer price?
Both can happen. So in the first case, where we expect the broad category to do well, again, we just expect that people realize that as a group, these companies are too discounted, and that discount closes, comes back to normal, and you make some windfall gains off that. We have both a long-only product, or a set of long-only products based on this idea, as well as kind of long-short implementations based not only on the idea that deep value stocks will come back to normal, but that extreme growth stocks will also see their prospects being reevaluated and will come back to normal. But
okay, and will that make deep value look relatively more attractive, do you think? As the current high growth, if the bloom starts coming off that rose a bit, will people be looking around and say, hey, wait a minute, maybe we threw the baby out with the bathwater with these deep value guys, and we should look at them a little more seriously?
I think so. One very interesting thing that happened after 2020 is value stocks in general sold off at very extreme levels. So from 2017 to 2020, they sold off, their discount widened, but in 2020 in particular, they became extremely cheap relative to the rest of the market. And some of that has to do with the pandemic hit stocks becoming part of the value basket and looking very cheap. So those leisure and hospitality stocks, those airline stocks, all became value stocks as a result of the pandemic. And some of it has to do with broad value as well, becoming cheaper. But then in 2022, when you saw the growth bubble starting to show some signs of popping, and you saw the Pelotons of the world, the Wixes of the world, the HubSpots of the world, all see their valuations crater, you also saw value outperforming and coming back toward average. Now, what happened was more of a growth sell-off than a value melt-up, if you will. But there is this sudden bifurcation that happened in the US market where shallow value companies, so those that are kind of cheap, but not extremely cheap relative to the rest of the market, actually begun to trade at a discount that was higher than normal. But deep value stocks, the ones that are extremely cheap, remained extremely cheap. And that opportunity, I think, is very unique, and it is why we have launched the suite of products that we have.
Okay, so I'm leading up to a question here, but I guess real quick before I ask it. So obviously with deep value, critics would say, well, they're deep value for a reason. You know, these are struggling companies, or they've got something about them that makes investors much more interested in other things, or that I think give them a better risk return. Um, what is it about the conditions right now that makes GMO so sanguine on this sector? Do you expect something to happen on the macro side to kind of make people reevaluate these companies' prospects?
The main thing isn't a particular catalyst. The main thing is price. You end up making in returns something proportional to what you pay. If you
Mhm.
have the most wonderful company in the world, but it is priced at infinity, you will never make anything off it. If you have a company that is fine, but it's priced to deliver just terrible performance, you can make a wonderful amount off it, both from its underlying cash flows and from the reevaluation of what that company is able to deliver by other market participants. Now, when we look at deep value today, we are careful. We are not just looking at the companies that have the lowest multiples in the market. We are trying to build out projections of the cash flows of these companies. We're taking into account the underlying quality of these businesses, and we're trying to hold the businesses that, given their potential growth trajectory, look very cheap. That's why we're sanguine about these businesses writ large. And one thing that gives us confidence as well is that it doesn't seem like it is the same story for every company we're talking about. In a deep value basket, you have traditional value companies like banks, where you can buy a JP Morgan that has amazing management, very good free cash flow at 12 times earnings. You can go ahead and buy a company like Pfizer, that we've talked about, whose prospects have come down, and we think will eventually benefit from investors realizing that it may improve over time. You can buy companies like Meta, where again, those are a typically growthy company, but priced to deliver returns that are quite good considering its existing multiple and its growth potential. So there are a bunch of idiosyncratic stories, and you can benefit just by holding a basket of all of these idiosyncratic stories and exposing yourself to this broad, systematic, deep value factor.
All right, it's a very helpful answer, and it's actually providing a great bridge to the next series of questions I want to ask you, which is what you are describing there is a very active approach to investing, where you are looking at the individual companies for their individual situations and opportunities, cash flows, et cetera, and assessing, okay, this is why we consider this to be a deep value company, right? And then you're building a basket of that, right? It's very different than the passive approach that's been so common for the past, what, 15 years or so now. And I've had a lot of guests in this program, so you don't necessarily have to make the same argument, but have said that, hey, look, it's going to require a different playbook going forward than we were able to enjoy up until the COVID era. And it's interesting because there's a lot of people that still seem to be desperately hoping we can just get back to the easy days of pre-COVID and maybe even during COVID, where you just buy the dip, you just set it and forget it, you buy the sector ETF and just it's going to go up, right? Many are making the argument that an active approach is going to be much more successful, maybe even required for gains going forward. Had folks like John Hussman on the program, who's analysis shows that uh, given current market valuations, the expected return of the S&P for the next 12 years, or something like this, is negative. Annualized return is negative. So we could have a lost decade in terms of the major indices. Doesn't mean you can't make a lot of money during that period,
Mhm.
but you're not going to do it with a passive strategy. You're going to have to do it with an active one. Let me ask you this before we get into the active versus passive, because I know your most recent quarterly letter was really all about passive investing and some of its challenges going forward. When you talk about the market sort of deciding to have a reevaluation and maybe taking a better look at these deep value companies, um, you used Meta as an example where the market sort of fell in love with the promise of what the metaverse could offer, but then over time realized, wow, Facebook's spending a ton of money on this, and we're just not seeing a lot in terms of incremental revenue. We're kind of falling out of love with it, and they punished Facebook as a result. There's a growing number of people who I think are making a similar case about AI,
Mhm.
right? Which is that there's hundreds and hundreds of billions being spent right now on CapEx for AI, but we're not really seeing that much of an increase in incremental revenues that we can point to it right now. And maybe there'll be some substantial cost savings that come out of it. There probably will be. But I think folks are beginning to say, maybe we got ahead of our skis a bit on this one. And I think it's opening the door to where a lot of the Magnificent Seven, whose market caps have swollen so much in recent years because of the promise of AI, might get similarly punished. And if they do, looking from the cheap seats, that might be a reason I could see the market could say, whoa, we threw a lot of market cap at this thing. Maybe we're going to move away from that for a while. Where should we direct our capital to going forward? That might be a trigger for a reevaluation of the deep value sector. Do you guys think similarly, or am I just seeing a pattern where none exists?
Uh, it may be the case. The reality with AI is, as you mentioned, we do not know what the return on investment is going to be on all of the investment that's currently being deployed. This is probably going to be a technology that will have revolutionary consequences. I think that's fair. Uh, but we don't know if the current set of companies are the companies that will be the ultimate beneficiaries. We don't know which technologies will become obsolete as a result of this. It's still very early stages. And it is absolutely possible that there is a lot of CapEx being deployed, and that capital cycle might be one in which we're seeing overinvestment. I I am not an expert on AI. It is possible that that's not the case, but it is also possible that it is the case. So it could be a catalyst for a reevaluation of valuations of specific companies. Um, it could also be a catalyst for reevaluation of how different segments in the market trade relative to each other.
Okay. All right. Yeah, I just see a lot of similarities there. And again, Meta may end up making a ton of money in the metaverse going forward.
Mhm.
It may be the company that realizes the metaverse's dreams. But to me, there seems to be.
Advertising is a wonderful place to start, though.
Yeah, exactly, exactly. All I just look at that and say, hey, that's a pretty recent example where AI, metaverse, pretty interchangeable. Again, nobody has a crystal ball. Nobody knows what's going to happen. I am seeing, though, a lot more people begin to question the AI spending, and so it would not surprise me at all to see eventually the capital screws getting tightened unless we start seeing some real noticeable operating results at these companies. Okay, so the theme of the latest quarterly letter that GMO put out, which you were a co-author on, it was very much focused on passive investing. And if we could, you guys raised 5 important questions that the letter walked through. Can I just sort of toss out those questions and let you give kind of the cliff notes to your thoughts on each one?
Absolutely.
Okay, and I guess before I do, to what I just mentioned there in terms of passive having been a very successful strategy for what I would consider the majority of investors up until recently. Uh, do you agree with the sentiment that an active approach may be superior going forward into the type of market regime that GMO sees ahead?
Yes, I think the reality is that passive has been as successful as it has because the largest companies in the market have done the best.
Hmm.
Active managers as a group have to hold the market, but institutional active managers tend to skew slightly smaller. They tend to underweight the very largest companies in order to make room for bets on companies that they really like. So, as a group, institutional active management has trailed passive in part because those very big names have done exceedingly well. And their fundamentals have grown amazingly well. There's a reason we call the Magnificent Seven magnificent. But at the end of the day, we think there is a lot of opportunity in the rest of not just the S&P 500, but in the rest of the world, especially outside the United States. So we do think it is an environment where you are getting paid for taking risk in companies that are not here and that are not necessarily the largest companies available to you. And that's an environment in which we think active managers are more likely than not to perform.
Okay, great. Well, let's just dive right into these questions then. The first of which was, has the rise of passive investing affected market efficiency?
There are two types of market efficiency that are worth touching on this question. The first one is top-down efficiency, which is how equities trade relative to bonds and whether there is more inefficient pricing at the asset class level. And the second one is, let's call it bottom-up efficiency, which is about how different types of equities trade to each other. Now, the reason that an academic might give to say that passive investing could improve market efficiency is because it is replacing the active managers who are the worst at managing money. The reality, though, is that the active investors who are worse at managing money are probably the active investors who are buying meme stocks and doing things that don't really make sense, that have no underlying, that are completely untethered to what is happening to company cash flows. Now, those investors are not the ones who are saying, oh, I am a terrible investor. Let me put my money into an index fund. So that said, how are we seeing market efficiency actually being affected? The first one is we are seeing greater flows from leaving, let's say, elastic multi-asset class active managers, so people who can invest in both bonds and equities, and going toward target date funds, which have these very explicit mandates. And that might be causing a little bit of inefficiency to creep through in relative asset class investing. If you look at the market in the bottom of 2009, you had real yields that were negative, and at the same time, equities trading at very low multiples. That was a time when the equity risk premium was extremely wide.
Mm-hmm.
Today, we have the real rate at, let's say, 2% on a forward-looking one-year basis, and equities are trading at 24 times earnings in the US on a trailing basis. That is a very different equity risk premium. Now, a target date fund doesn't say, oh, I can get a lot more by investing in cash, so I'm going to change my allocation. It only changes that allocation based on the age of its investors.
Mm-hmm.
So yes, I do think we see a little bit of inefficiency creeping in there. And we can get into that a little bit more on one of the subsequent questions that we answered on mean reversion. On the bottom up side, we're probably also seeing something happening where certain types of stocks are getting a little bit too discounted just by the nature of passive investing. But the specifics of which stocks are rather in the weeds. So maybe we should uh, keep going before we go into that.
Okay. Let me just add one other question here. So I've had guests on this channel like Michael Green, Bill Fleckenstein, who talk about passive capital flows, which I think are part of the passive story here. And a material part of them is the programmatic buying that gets done every month by retirement funds of corporations, right? People working working for the corporation, they have a percentage of their paycheck going into their 401k. This money has to be invested every month, right?
Yep.
And so they call this the giant mindless robot. Whereas as an active capital manager, you can look at an asset and say, you know what, I don't like its valuation today. I'm going to wait. I'm going to wait for a better entry, right? With these passive capital flows, they're price insensitive. It's, hey, given the check boxes that this person made in terms of how they want their money invested, we just paid them. We got to put 20% of that, and we got to buy these stock. We got to put it in this fund or whatever, right? And then that fund is allocated. I think right now the math is something like every dollar that gets invested in the equity market, like 37 cents of it or whatever goes into the Mag 7, something like that. They get a very disproportionate share of those dollars that are coming in. So I guess my question is how distortive is this, or quote, inefficient are these passive capital flows that are just coming in month after month and just saying, I don't care what the price is, I just buy it?
So there are 2 points worth making there. The first one is that, yes, we have seen a change in how regular these flows have become as we've transitioned from employers managing their employees' retirement funds to employees having the responsibility of managing those retirement funds through their 401ks. And generally, employees do not change their 401k allocations very often,
Right.
or how their contributions are allocated for that matter. But we have always had flows coming in from paychecks and going into equities and bonds. The difference, I guess, is that, as you mentioned, this is now being done with much less focus on the prices of the assets that are being bought. It is being done, let's say, with a blindfold on, to mimic your gesture there earlier on. This is likely to contribute to some distortion in markets overall. So it can boost valuations for the broad equity market, where we are seeing basically the marginal dollar looking a lot less price sensitive than it has in the past, a lot more inelastic in academic parlance than it's been in the past. But it is not an effect that is very easy to tease out from the data. I think one issue that we had in our letter was that we wanted to give these really definitive answers. But the fact is that there's so many changes happening at the same time in equity markets over the past 2 decades that it's very difficult to give definitive answers to some of these questions.
Okay.
So again, we think there's been an effect, but it's very hard to talk about the magnitude.
That's fine. I think right now we're in the directional versus definitive, and I think that's good enough for the government for right now in terms of, you know, viewers and what they can take away from this discussion. So moving on to question number 2, the question I just asked you plays a role, and I'm sure a little bit too, but is the increase in passive investing behind the rise of today's mega caps?
We don't think so. If we look at the Magnificent Seven in particular, what you see is that they've been able to grow their earnings per share at 20% per annum over the past 10 years. The average company in the S&P has probably grown their earnings at 5% per annum. That's a 15-point gap. Then, if you look at the valuations of those companies, the Magnificent Seven have seen their valuations grow by a little bit more than the average company in the S&P, so maybe 5% versus 3%, but that's just a 2-point gap. If we just look at those two numbers, the main reason behind the rise of the mega caps is the fact that their fundamentals, their earnings, their sales have really grown at a clip that is essentially unprecedented for a group of stocks, and just reliably so. Now, could passive have had an impact on the valuations of these companies? Sure. Again, we're trying to explain a much smaller portion of the overall rise in the mega caps, but nevertheless, we think there could be an impact. And the reason we think there could be an impact is active managers on the institutional side writ large tend to be underweight these companies, as we've talked about before. And they have position limits. They have tracking error constraints. They have career concerns around the fact that they are not investing in companies their clients think of as being magnificent. So there's only so much risk they can afford to have in being underweight these companies. As these companies' prices go up, they have to buy these companies as well in order to keep that underweight in place. If a passive fund comes and says, hey, I want to buy every stock in the market, who wants to sell me mega caps? It's not the active managers who are already max underweight on these companies that are able to sell them. So if that pool of capital is not willing to sell its shares, if it's a lot more inelastic than normal, then yes, valuations can become a little bit more stretched as a result of the absence of ready sellers.
Okay, and that's going to factor into this next question. But real quick, let me just ask you, because everything you just said there makes total sense about why the mega caps have sort of deserved their outsized share, because they've grown they've grown into it, right, from an earnings standpoint. And Nvidia is probably the poster child for that, right?
Yep.
But let's contrast that with Apple.
Sure.
Right, which is a company that has had a really hard time growing revenues of late. And Apple hasn't been the highest flying of the Mag 7, the past quarter or two, but it's still hanging in there pretty well. I guess where I'm going with this is a factor I think that has contributed to Apple continuing to be a stock darling has been the scale of buybacks. And when you look at, these mega caps, these are companies that don't have a lot of debt and have a lot of cash and are able to do buybacks in the scale that most other companies are not able to do. How big of a factor is buybacks into this whole mix of keeping these, mega caps as robust as they've been, stock-wise?
In a market that is generally more inelastic than it used to be, where there are fewer people who are ready to sell their stock as the price goes up a little bit, a buyback constricts that further, right? You end up taking yet more stock away from the pool of ready sellers if the corporation is coming and buying those stocks. So it can absolutely have an effect. Now, quantifying it is, again, difficult, but it is definitely important. One reason, and maybe I'm preempting a question down the line, that
if you are, thank you.
that we would expect that there are limits to how much passive can impact markets is because if passive were to keep pushing up prices and valuations as a result of fewer and fewer active investors being willing to sell their shares, then companies would come in and issue stock, right? If you are GameStop, if you are AMC's management, you are going to look at those crazy valuations and sell into that. You can do that for the benefit of your shareholders, in fact. Now, the reality is that we haven't seen that happening for the Magnificent Seven. So we have seen instead, as you just mentioned, a little bit of the opposite. So of course, there's some stock issuance that's occurring in part as part of the compensation programs of these companies, but buybacks in most of these companies are more than offsetting that stock issuance. So it does play a role, or very likely plays a role.
Okay, so it's part of the directional equation here. All right, your next question was, is the increase in passive investing hampering the performance of small caps and value stocks? I think you already gave a little bit of a nod to this, that the active investor, you know, kind of like nobody ever got fired in the old days of advertising. When I first started in media, you know, it was nobody ever got fired for buying an ad in the Wall Street Journal, right? So nobody ever got fired for investing a little bit more in NVIDIA in recent times, right? But if you don't buy NVIDIA, but you buy small little tiny company X hasn't performed very well, there's some career risk in that.
Yeah, I mean, absolutely. I will say that if you invested in NVIDIA in the top at 2021, you subsequently saw your stock go down roughly 60% in 2022 before ChatGPT and the AI revolution began.
Yeah.
So maybe you did get fired.
Right. Yes.
I'm not entirely sure.
In the past couple of years, though, you basically
No.
your investors were threatened to fire you
Of
if you weren't
course,
buying
of
it.
course, yeah. But to your question, so active managers tend to skew a little bit smaller. So if there is money that's flowing into passive that would have otherwise gone into institutional active management, or money leaving institutional active management and going to market cap weighted vehicles that tend to skew larger, so S&P 500 ETFs as an example, then we would assume small companies would end up trading at a wider discount. Now, we have seen small caps perform quite poorly. Again, part of that is because these companies' fundamentals just haven't kept up with the rest of the market. One of the just very stark facts of the past 2 decades is that profit margins for the S&P 500 have broken from this mean reverting trend, 50-year-long mean reverting trend, and started going up. And if you look at that same chart for profit margins on small caps, other than this brief uptick during the pandemic 2020, 2021, they've actually kept that mean reverting trend going. They didn't benefit. They didn't see their profit margins rise as we'd seen for large caps overall. Now, we do think this impact on small caps is, we do think that small caps have actually suffered a little bit as a result of passive skewing larger. The story with value is more complicated. It's not necessarily the case that value companies should underperform because there's this negative demand shock for them. A passive vehicle buying companies in the S&P 500 buys all of the companies in the S&P 500, whether they're growth stocks or value stocks. The thing about value stocks is that their investors tend to be a lot more price sensitive. If you look at the typical value investor, it's somebody who talks about a margin of safety. It's somebody who is trying to get some of their return through income. So if prices go up, their return really changes, and they are a readier seller than their growth counterparts. A growth investor is much more focused on the future outlook of companies. If prices change by 1% or 2% today, they're not going to be jumping up and down to sell their stock. They generally believe the stock is worth a whole lot more than they paid. So I think from that perspective, if you have more price-sensitive investors in value and less price-sensitive investors in growth, what will end up happening is that as a passive fund comes along and says, I want to buy shares in everyone, the the value investors will demand less of a price increase to sell their shares than their growth peers. And as a result, growthy companies should end up seeing their prices go up by more due to these flows coming in than value companies. And we do see a little bit of that in the data. That's not the main cause for which value has begun to trade at this extreme discount, but it's probably a contributing factor.
Okay. John, I'm looking at the time. I'm going to start jettisoning questions here just to be able to be respectful of your time, but we might run a tiny bit over if that's okay.
Yeah, perfect.
So let me jump to the last question here, but if there's more of the points you want to cram in besides this last one, feel free. Last question on passive, which was, okay, so everything we've just discussed, does passive investing create opportunities for active investors?
We think it does. There are opportunities for shorter term investors and longer term investors. For shorter term investors, flows begin to matter a lot more. There are these inelastic flows coming into markets. Timing them and providing liquidity to them is generally going to be a profitable activity. If your counterpart is price insensitive and information insensitive, then you want to transact with them.
Right.
You're not going to face adverse selection by trading against them, and they are willing to pay any price. So it's lovely to be a liquidity provider for them. On the longer term side, if you are seeing wider spreads forming for certain types of companies because of these flows, then they also present opportunities because you can buy certain types of stocks at a discount when you wouldn't have been able to in the past. Again, this isn't the same level of risk-adjusted return as you get for being a high-frequency trader and having passive vehicles as your counterpart, but you do get better returns as a result. And I think part of what makes us very, optimistic, even in the face of passive investing, is that the math of returns doesn't really change with the presence of passive. You will get returns related to your cash flows and the price you paid relative to your cash flows. If that price is smaller, all the better for it.
Okay, so kind of what I took away from all that was, look, passive creates price distortions. We don't know exactly to what definitive magnitude, but they distort prices. They have a net distortive effect. For a firm like yours that plays on mean reversion, that's a great thing, right? Because it just gives you like a bigger wave to surf, if you will.
Sure.
Okay.
Yeah, I think we have to be careful about whether passive is impacting the speed of mean reversion in certain things. But so long as we are investing while keeping in mind that it may take more time for certain asset classes to see their valuations come back to normal, we should be fine and we should benefit.
Okay. And I think many investors would probably accept that trade-off, right? Which is if the probability of the trade coming out the way I want it to come out is higher, but I have to wait longer for it, I think most prudent conservative investors would probably make that trade-off if they could. Okay. You sort of said this just a few minutes ago, but I want to really point it out both for the audience, but also to ask you a very specific question. One of the concluding sentences in your report says, it's important to keep in mind that whatever effects the rise of passive investing has had, it doesn't change the way that stock investors make money in the long term. The primary drivers of long-term returns in the stock market are the future cash flows of the underlying companies and the prices that investors pay for those cash flows, right? And that's, I think, your whole argument for why these deep value companies look so great right now is looking at the fundamentals of their underlying cash flows. They are underpriced substantially based on that, right? That's what you're hoping to ride the repricing on. So That's for deep value. When you just look at the general stock market today, and you gave a little nod to this, but I just want to ask very clearly, does GMO think that stocks on average are overvalued today, given their likely cash flows, likely future cash flows?
We think US stocks broadly are poised to deliver returns that are unattractive to investors, uh, given their risk profile. We think that there are pockets of US equity markets and equity markets across the world that are poised to give normal, if not above average, returns for bearing equity risk. So it really depends on the stock market we're talking about. Again, if we're just looking at the S&P 500, we think that it is broadly poised to deliver subpar returns over the next year.
Okay. All right. I'm just figuring how much of the many questions I have here that I'm throwing out that I want to try to squeeze in here. I guess one is we started at the top talking about slowing demand, normalizing labor markets. I raised the question, could the Fed, could the Fed's actions swing from normalizations into overcorrect? And I gave, at least my opinion, I think many people share it, but if you have a different one, let me know. I think history sort of shows that's the way it generally goes. When you're looking at the labor market data right now, and just the general economic data, how concerned is GMO about the odds for recession in the next, let's say, 12 months?
So to be clear, we don't focus on forecasting recessions in our investment process. We do take a look at the economic data for a variety of reasons, but we're particularly focused on trying to identify portions of equity markets and of fixed income markets that are likely to do well, irrespective of what can happen over the next 12 months. So there may be vulnerable pockets in the economy, and leveraged small businesses come to mind here that we want to avoid, precisely because if these businesses that are operationally levered and financially levered hit a recession, man, they are going to suffer. Now, I can give you my personal opinion on the probability of a recession. And again, there may be dissent internally in terms of what different investors at the firm think.
All right. So this is John Pease's opinion. We're going to hear, not GMO's.
Exactly.
Okay.
Yeah. So whenever we see unemployment increasing, our first instinct should be to say, oh dear, what is going on? The rise in unemployment this time, though, has been mostly because of an increase in participation, in people looking for jobs. And that is a lot less concerning than a rise in unemployment caused by people being laid off. When people are being laid off, they are going to cut spending. Their friends are going to hear about it. Their friends are going to preemptively cut spending. Economic activity is going to be reeled in. When you have a lot of immigration into the country, labor supply is increasing, then it is normal that after you've had a ton of hiring happening in the economy, and after the economy has gone through such a weird rebalancing as it has during this post-pandemic period, where manufacturing and services have just been completely out of sync, where the housing market has been, I don't want to say broken, but it has been a lot less easy for people to move because they have to give up on very favorable mortgages where they live in order to buy a house elsewhere. So the search process in the labor market was probably a lot slower than usual. And as a result, I am assuming companies are hoarding a little bit of labor, as we've talked about, and maybe now they're being a little bit more careful in their hiring. I don't think that is as much of a cause for concern as the typical layoff cycle. Now, we do see economic activity trending down. We have seen the SOM rule being triggered. So we should keep a watch on the data, but most of the data is not particularly dire right now. I have seen people, and I think I saw a couple of participants on your show talk about the quarterly census of employment and wages diverging a little bit from the payrolls data, saying that 800,000 fewer jobs have been created. One thing to point out on the QCEW, trying to get my abbreviations right,
Good job.
uh, is that that data comes from businesses that are doing formal hiring. So anyone who's hiring an undocumented immigrant, for instance, and this has been a period when we've seen a lot of immigration into the country, is not going to be reporting uh, a job opening there. So it may be that that data understates a little bit what has been occurring. And despite the payrolls being a survey and a noisy survey, they haven't been flagging anything too worrisome yet. So that's a broad overview, but I'm happy to get into details.
No, I appreciate you sharing that. I'm going to specifically avoid getting into detail with you just because we're at the hour and I want to be respectful of your time, and I still have a few other things to do as we land this plane. But a ton of questions that I would love to ask. I look forward to, John, if you're willing to come back on this program at some point in the future, dig into you further with them then, and maybe we'll have a little bit more, you know, detail in the data between what's happened between now and then. All right. John, look, this has been a fantastic conversation. Really appreciate you coming on. Like I said, cannot be more complimentary of the work that you and the team there at GMO do, and I think you've come and represented them really well here. So I don't even need to gush because people have already seen the quality of intellect and rigor that you guys bring to your analysis here. I guess before I get to my kind of wrap up questions, in terms of your outlook. You know, I usually ask people like, what are your favorite strategies and favorite assets for the type of outlook you have, you know, looking ahead. I think we kind of started there with you, which it sounds very much like you guys are looking mostly at high quality companies, deep value companies. Again, we're all talking about the equity side for the most part here right now. We didn't talk a lot about it, but you did mention that some of the biggest opportunities in both, particularly probably in the deep value, lie outside of the U.S. And I know that's a big part of GMO is you know, looking at emerging markets and just not the U.S. Universe. Is there anything else that you'd like to say about GMO and its current outlook, positioning, et cetera, about the markets and where you see the biggest opportunity that we haven't already talked about?
Well, we've talked about the fact that we see a lot of opportunity in international markets, so both in Europe and emerging markets in Japan. But one thing to underscore is that US investors tend to have this very deep home bias. That's not just true of US investors, it's true of most investors. So irrespective of which country you were born in, you tend to invest a lot in that country. And there are benefits to that. If most of your liabilities, if most of your costs are in US dollars, it is good to have a lot of your revenue and a lot of your wealth in that same currency. But there are also benefits to diversifying. And I think we have been in this period where diversification has really hurt investors, not just diversification outside of the US, but even diversification within the US equity market has been very painful. If you didn't hold those top 10 stocks, boy, did you underperform. But it is not a bad idea to diversify. And I think there are wonderful opportunities that may be outside of your listeners' comfort zone or what they usually invest in. And I would encourage them to see whether they can take advantage of those opportunities. Because what you really want to do when investing is to be taking risk where you are compensated for doing that. And I'll I'll end this comment on that statement.
All right. Well, it's very well said, a very wise and important statement. All right. Well, look, John, for folks that have really enjoyed this conversation and would like to follow you and your work and the work of the team there at GMO, where can they go?
GMO.com is the source of all of our materials. So we have a research library with our quarterly letters, our white papers, and we try to publish insights on a regular basis. So feel free to go there. I think it's where you'll find me and, more importantly, my colleagues.
All right. And you're much too humble, John, but thank you. So I'll be shot if I don't ask this question. What's it like working at an organization where you're able to access the expertise of the likes of Jeremy Grantham?
It's amazing. I mean, I think one of the truly great things about GMO is that you are encouraged to be intellectually curious. You are encouraged to talk to everyone. It's an extremely horizontal organization. I was very fortunate that when I joined as an intern, Jeremy needed somebody to be his analyst. So I ended up doing that for a few years. And so I got to spend some time with him as well as the other folks in the asset allocation team. So uh, I personally have benefited immensely from this and have benefited from being able to change the focus of my research from one area to another quite frequently, while having all of these very smart, very open-minded people willing to collaborate, willing to hear me out, to correct me when I'm saying something stupid. So it's I may be gushing, but it is a wonderful organization.
Wow. I know that there is a lot of collective envy amongst this viewing audience for the opportunity you've had there. Obviously, very well deserved. But man, what a wonderful uh, what a wonderful training ground for a young mind like yours to have matured in within, and what a phenomenal individual mentor and then team of wonderful colleagues to learn from. So, anyways, I'm gushing here too, but again, it's all for good reason. So, John, I really hope we get a chance to get you back on this program at some point in the future. Before I let you go, one last question for you, which is, you are younger than the typical experts that I have on this channel. You work at such a phenomenal place. You clearly have had a lot of success so far in your life and been working with some of the highest caliber people in the world of investing. What's one important lesson you've learned along your journey so far that you think is worth sharing with the audience today?
I'll give you one professional lesson and one personal lesson as well. On the professional lesson, I'd say be curious, ask why. It's uh, a little bit of a cliche, but honestly, going back to first principles, asking why something happens, why people have certain beliefs, trying to understand how different minds assess the same problem is generally a wonderful way to learn. And on the personal side, I'd say the main lesson I've learned in the course of my life is to uh, practice your sense of humor. Honestly, there are not everyone's born funny. Not everyone comes from a family that values levity, but it is wonderful to be able to take your life with a little bit of laughter and understanding that even when things go wrong, uh, life is worth living. So, sorry for the two very corny answers.
No, they're both wonderful answers. Your first one, I mean, I ask why for a living, so how can I not agree with that? And on the second, yeah, levity definitely, as they say, is the spice of life. I think I'd say brevity is the spice of life, but levity is as well. And if there are a number of people that come on this channel that are kind of pessimistic about where things are headed in the economy. I know that you're. I'm not going to put you far on the bearish spectrum, but you've even raised a couple of things here that you're keeping your eye on, right? If we end up going through some sort of tougher times, oftentimes it's finding the humor in it, even if it's gallows humor, is the thing that makes it bearable to be able to make it through the tougher times. So yeah, levity helps us appreciate the good times even more so, but it really can help us get through the tougher times. So I agree fully with both. Jonathan, it has been just a real privilege and pleasure to get to meet you here. Thank you so much for coming on. Would love to have you come back on this program again later this year if you'd like to.
Thank you so much, Adam. I'd love to return and really, really appreciate you having us.
All right. Well, now's the time in the program where we bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money, to both react to what John and I talked about, as well as discuss anything meaningful that's happened in the markets over the past week. I'm joined as usual by John Lodra and Mike Preston. John is joining us for the road. Thanks for taking time out of your trip to do that, John. So why don't we start with you? And let me preface all this by saying I mentioned a couple of times during the interview with John Pease that not only myself, but that a lot of our financial advisors that Thoughtful Money works with, including your firm, thinks very highly of GMO. So I'd love to hear you, give whatever color you want to give to how GMO's analysis affects your work there at New Harbor.
Hey, Adam. Yeah, great to be with you, and super thrilled that you were able to have John join you. We Mike and I and our team have been long fans of GMO, and it's not just because they're in our backyard, headquartered in Boston, but they have been decades-long stewards of capital in a very informed and data-driven way, and they speak very, I think, candidly to the solemn oath that we as asset managers share with them, in that we ultimately have a duty to invest our clients' money with the insight of perspective of markets and returns and over timeframes that matter to clients. And a big part of that is not getting caught up into the short-term machinations of markets that can be absolutely nonsensical. They can be. That's why bubbles happen, and we think we're in the midst of a bubble, and we've been playing it very cautiously as such. But some big broad takeaways. GMO puts out a 7-year asset class forecast every month, and I might as well just share, because I don't think he brought this up in the call or the video with you, but let's share that just so we can kind of look at that together. So this is their 7-year asset class forecast. I'm going to hide our faces here, but they basically every month put out a 7-year asset class forecast. And you can see this is as of June 30th, 2024. And this is their forecast, real return forecast, meaning inflation adjusted after inflation for various asset classes over the following 7-year period. And you can see this chart speaks to what John articulated in your video with him. U.S. stocks are, broadly speaking, very extremely overvalued and therefore likely to deliver very disappointing returns over the horizon from current levels. That's all a function of starting valuations. But on a relative basis, international stocks, especially emerging market stocks, are much more compelling valuations and likely to do much better. Bonds, you can see their forecast for bonds here. Now, as John pointed out, that many U.S. investors do have a home turf bias, think largely of investing in U.S. markets. So to have such a, divided asset class forecast may strike U.S. investors as a bit curious. But in fact, if you look at many other strategist firms, GMO's calls aren't that dramatic. So, for example, if you look at Vanguard's latest capital market forecast, and I will find that in just a second here, they pretty much share the same thing. Basically an outperformance or likely outsized returns for foreign stocks relative to U.S. stocks, and I'll share that right now because I have it up on my screen. So this is Vanguard's forecast. You can see broadly U.S. equities. They have, and this is as of May 31st, I think. Yeah, May 31st. First, so a few months out of date, but they have a range over the next 10 years of 3.4 to 5.4%, much lower than the historical average. Now you can see here they've got global and emerging market equities, much higher expected returns. But they also share the same view as GMO, U.S. value likely to far outpace, for example, U.S. growth. So as contrary to popular opinion that GMO's views might seem, they're actually quite consistent with many other strategists, including Vanguard, which is obviously the firm that's probably most associated with passive investing, which of course is one of the topics that you and John talked about. I do want to call out the broad takeaway, though, is even both stocks and bonds are not super compellingly valued. And that's why even things like short-term treasuries and cash still have a very relevant role. Right here, you can see Vanguard actually has cash returns likely to be competitive with, if not exceeding, stock returns at far lower risk. So to sum it all up, we see things very much the same way. The short-term market machinations can sometimes belie what the longer-term fundamentals speak to, and that's why we're fairly cautious in playing it. We're using short-term indicators to capture strength where we can in sectors that are strong, but we have about a 40% allocation to equities right now because of this very overvalued backdrop and sanguine return expectations from the present tense.
All right, and John, coming to you in one quick second, Mike. But John, in terms of GMO's kind of fundamental market approach of looking for mean reversion, right? Looking for assets that have a high degree of likelihood to mean revert because they're at an extreme. John sort of walked through some of the ways in which GMO, where it's looking most for that type of mean reversion. In terms of how you guys allocate your portfolio there at New Harbor, are you borrowing some of that approach in what you guys do there?
We do broadly, and that speaks to why we're not 100% in equities right now, or wouldn't be, even if the short-term technicals were pounding the table to be. I did want to add that GMO also does we've gotten to know the folks at GMO pretty well because they've done some real seminal work on what valuations mean in terms of optimal allocations, even for retail investors. Even though most of their work is with large institutions, they've done some really important work on valuation-based asset allocation. So, for example, they came out with a white paper recently that basically raises eyebrows about the traditional method that most investment firms like ours use. We don't apply this approach, but most firms, basically have a client answer a risk tolerance questionnaire, and that is the input that guides all of the investment allocation decisions. It's almost like ignorant to valuation. And there are many flaws with that approach, including the reality that most clients don't really understand the question that is being asked of them in terms of what is your risk tolerance. And even at that, we humans, and we put ourselves in this bucket because we're human too, we have a very poor ability to judge our own risk tolerance. That's why we are so grounded in data, because it helps us behave in times that we otherwise would not, because our emotions would get the better of us. But to back to your point, I mean, we certainly kind of use the bigger picture fundamental backdrop, including the likely directional mean reversions in allocating. So, for example, we're decently in our 40% equity allocation, we are decently allocated to emerging markets equities. Because of the very reasons that have been articulated by folks like GMO.
Okay, all right, Mike, coming to you now. Anything that you want to lay on top of what John said there in terms of John Pease's discussion?
Just my own quick recap. John talked about there's been a meaningful, or GMO expects a meaningful slowdown, and we're starting to see it in the data. And the two things that they really favor are high quality companies and deep value. And John talked about how deep value became really cheap in the COVID drop, with the COVID slowdown, and it's remained cheap. And that's very frustrating, but it's also an opportunity if you believe in mean reversion. But believing in mean reversion has been frustrating for just about anyone that's done it, including us. John Lodra, my partner, just talked about how we invest in emerging markets. That's mostly a fundamental play because there we see valuations that are normal. They're mid-teens, maybe 15 or 16 on price earnings ratios on average, versus the US, which is 35 to 40. based on the way that we measure it, the way that we think it should be measured, something like the cyclically adjusted price earnings ratio over a 10-year smooth period. So deep value has remained cheap. That math doesn't lie in the end. John Pease talked about that. Math does not lie in the end. We talk a lot about that. Now, this has been a very long time that things have been different and that math hasn't mattered, because in this era of money printing and quantitative easing, that it's really kind of skewed things to the upside. But long term, we think that valuations matter and that math matters. And so you really have to be patient and pick your side. That's why we're roughly 40% in equities, because even though we say that there's a very high chance that this market sees one more spike higher, we're not willing to trade from that viewpoint. We're not willing to jump all in, because really it's a crash prone market from these fundamental heights. And so it's really difficult as a money manager. GMO faces the same thing. And we've got a lot of respect for Jeremy Grantham and the people over at GMO. They went through a hard time in the late 90s when we witnessed the tech bubble. They lost nearly half their clients back at that time, I remember reading. But they've stuck to their guns. And Jeremy Grantham himself, who I think is older than 80 years old, and sorry, Jeremy, if I'm making you older than you really are, but he's very public about calling out the bubble that we're in. And he's been writing about it for several years. And obviously, Jeremy and his firm are very successful. They don't have a lot to gain by sticking their necks out like that. We've got a lot of respect for them. And so here in this talk today, John Pease talks about ways to potentially navigate this set of conditions that's really, really unfavorable. And I think he did a good job. We try as well. And we're doing the best we can in a hyper overvalued market by focusing on the sectors that we think have opportunity. But like John Loder said earlier, T-bills, treasury bills are still yielding 5% on 6-month treasury bills. So it's a high bar to say that anything that you do has got to beat that, or at least it has to be expected to beat that. And so that's where we favor high relative strength sectors. Be happy to chat about some of those later. But we look at the strongest the technicals on the strongest sectors, and that's what populates most of our equity slice. And so I guess I'll pause there.
Okay, why don't we talk about those high RSI sectors right now, just because we're getting a little bit of short on time, and I want to pivot to a different topic in a second.
Sure. Yeah, so telecom is on our list. Software, semiconductors, metals and mining, utilities. In the US stocks, that's pretty much most of what we look at. Now, a few of those have given short-term sell signals, like software, metals and mining, and semiconductors. Semiconductors are probably the weakest of the bunch, but probably have, if they can bounce here, have amongst the best opportunities, probably. They're former leaders. If you look at something like SMH, it broke down badly to the low 200s. It had to get above 230 or so in my mind to have some healing in that chart. And I'm just taking a look at the chart here. It's at 236. So out of the group of strong sectors, most of which I just mentioned, we're constantly comparing those to other opportunities. Believe it or not, home builders just went on our watch list as a really strong chart. And from a fundamental perspective, we hate that. We home builders, we can't even stand the idea of putting it in our model, and we haven't. But we're very unbiased when it comes to taking a look at the technicals of these sectors. Biotech is also on that list, although we've got healthcare in our model, which has a piece of biotech. So a couple of them are on our negative watch list, like semiconductors, software, and metals and mining. But if they bounce, they'll stay in the model. But having said all of that, we're only about 40%, and that includes our emerging markets exposure of about 12.5%. So we're going to have to see if this market broadens out. The Russell 2000 has faltered recently after being strong a few weeks ago to a month ago. If that bounces quickly, if IWM goes to 215 or 210 even, that'll go a long ways to tell us that the market is going to continue to broaden out. But those are the sectors that we like. The thing that I didn't mention that's more of a fundamental long-term pick or view is the gold mining sector. We've got a 10% position in the model, and that is firing on all cylinders technically as well, but it's more of a fundamental longer-term play than the technical relative strength sectors that I just mentioned.
Okay, great. Super helpful list to walk through, and great to hear why you're looking at each one of those. John, I'm coming back to you now with a question that Mike sort of teed up there where he said, hey, the hurdle right now for determining, put capital into something new is you got to beat the 5% yield that you're getting on short-term US Treasuries. So we just had the latest CPI data come out this morning. CPI now has a two handle. It's at 2.9% year over year here. So disinflation continues. And at the end of the day, interest rates are a function of inflation expectations. And if inflation expectations are increasingly that inflation is going to hopefully eventually get down to the Fed's 2% target, then that gives Powell and the Fed and everybody confidence that they can start cutting the federal funds rate. And where I'm going with this is potentially the era of the 5% tasty, short-term US Treasury, sit in safety, get a nice 5+% yield, maybe going away. So as capital managers, what do you guys, how are you thinking about reacting to that?
Yeah, so that is obviously a very key input to the future investing decision. And the Fed has stood pat on rates since last July. We're over a year at their current target rate of 5.25 to 5.5. It's all but certain, at least the market thinks so, that the Fed will reduce rates to some degree at their next meeting in September. I will caution, however, that the market has been pretty excessive in their overshooting what the Fed is likely to do. If you go back to the end of last year,
they've been wrong forever. I mean, since the beginning of 2023, they've been looking for the Fed to pivot at every moment, and they've always had to walk back their expectations.
Yeah, that certainly in the track record has not been good. Late last year, the market was certain the Fed was going to drop rates, and they didn't, and so it was a complete mea culpa, right? Now, I think the market's probably got it directionally right, but I'm a little concerned that they may be forecasting too much in too far of drops too soon. I'll just share with you the kind of latest CME Fed Watch, which is just the kind of the market implied probability. So hopefully you can see this. Okay, this is for the September meeting. You can see here the September meeting, and I'll go down here to the table. It shows the today, after today's CPI report, is showing again a 0% probability that they'll keep rates at current levels, and that's pretty consistent. Even a month ago, there was only a 3.8% market probability that the Fed would keep rates at the current level. There's about a 56% and change implied probability that the Fed will drop a quarter percent, and about a 43.5% that they'll drop 50 basis points, 0.25% drops. Now, noticeably, look at the trend here. 1 week ago, it was over it was actually over 70% recently, but 1 week ago it was 69%. Now it's only 43.5. Even as of yesterday, it dropped about 10%. So the market's already backing off a little bit of the pace at which the Fed will likely reduce rates. So I think, put it this way, I don't think we're going anytime soon to 0% short-term interest rates like we saw for much of the last decade. So even still, whether we're talking 5% or 4%, when you're pricing in, let's say the Fed does take short-term rates down to 4% in the next 6 months or something like that. That's still a pretty compelling hurdle to get over in terms of where US stocks at least are valued and what their likely long-term returns are. And frankly, bonds are starting to become, on a relative basis, more compelling. Even though there's been a short-term rally in bonds, we think if the 10-year yield, for example, it's right around 3.8, I think today, 3.8%, which is not historically high. If you go back history, it's a low yield. So bonds are priced to yield pretty low returns over the next decade at current yields. But if we get into 4.25, we think that starts to become a compelling point to think about adding some more duration in bonds. Probably some in the belly of the curve, maybe a 3 to 10 year maturity, maybe a little bit more. We do have a tactical position about 10% in longer term treasuries, which have seen a nice rally of late. But absolutely, this enters the calculus, and of course, this all changes with retreats and valuations. I will talk about this recent last week or so, or 2 weeks. We had a kind of a panic sell-off of sorts last Monday, the 5th of August. Seemed like everything was going wrong, right? And we saw kind of a whiff of panic even amongst our clients that speaks to sentiment. And I want to share a chart here because we've seen a pretty short and vicious rally from those lows last Monday. I think the S&P is up over 6% in a little over a week. And Ned Davis did some good work here. And I'll share a chart that they put out. Basically, it's probably hard to see on this screen here, but this lower pane shows the sentiment, their sentiment composite, and it got below a 41.5% threshold. And let me get this bigger so we can see. You can see when it gets below that level, the annualized returns end up being really compelling. And already in the week we've seen since that August 5th sell-off, we've had an annualized return. If you annualize the 6+%, that even exceeds this. So we've had a very, very sharp and vicious rally here that has cleared, I think, a lot of that panic and negative sentiment. And we're bumping into things like the 50-day moving average we just poked through it actually on the S&P, but a lot of sectors are starting to, kind of bump into the 50-day moving averages. So we might see some consolidation here and perhaps a lot of the good news is already priced into the market, I think, insofar as interest rate expectations. So the next week or two, I think here will be very telling. The small and mid cap rally, it's got to prove itself here. It's in real proving ground right now. And if that fails, we think there's probably some leeway for weakness in the broader market because, again, a lot of it's very priced in the short term.
Okay. Well, whatever happens, folks, we'll have the guys here at New Harbor tracking for us every week, so we'll keep you updated. Very quick, just on this topic, and then Mike, I'm going to come to you on what's happening with gold, and then we'll wrap things up. What will you be looking at? What will go in your consideration process to determine whether or not it's time to go further out on the duration curve or increase your portfolio allocation to longer term bonds? If indeed you think, okay, you know what, the short term yields are coming down, maybe all yields are going to be coming down. Now's the time to sort of start playing that price appreciation of the longer end of the curve while we're still getting paid.
I guess that question's for me, Adam. Really, we base a lot of that on technicals, both on charts of the long-term bonds, charts of yields. As John said, the 10-year yield, which touched 5% several months ago, has dropped to about 3.8. It dropped right from 5 to about 3.7, then bounced up to around 4.3. We actually increased our position in long-term bonds. You could take a look at TLT and ETF as a proxy for long-term U.S. government bonds, and TLT was somewhere around 90 to 92 at that point. Yields have since pulled back. They pulled back to 3.7. They're here at 3.8, I think, and TLT is at 97. If we get a bounce back up towards 4 to 4.25, we're going to look to add something in the belly of the curve. We're not really that interested in adding too much more risk because, as John just said a minute ago, these rates are still not historically low. The rates could be 5 or 6 or 7% and still not be out of line with what rates have been on average over the last 50 years. But our viewpoint is rates really can't go back there anytime soon. Not with 34 trillion in debt, increasing by nearly 3 trillion a year. Fed balance sheet at roughly 9 trillion, I guess 8 and something probably right now. And we're spending essentially 40% of tax receipts on interest on the national debt. So I don't really think we can go back there up to 6 or 7%. I mean, nothing is guaranteed, but we don't think that's likely to happen. So we're looking at technicals, a bounce back up to 4 to 4.25. We'll probably add something in the 7 to 10 year time frame because essentially we think rates are going lower, maybe as low as 3% or even lower on the 10 year. They could even hit 2%. We'll see. If we get the kind of rollover that we think is going to happen in the equity markets, I think it's pretty clear that the Fed and other central banks will ease. They really don't have any other plan. They don't have any button to push other than that. And so we'd like to get more exposure to the belly of the curve as well. There's been quite a bit of a rally there in recent weeks. So we're going to wait for some kind of pullback. And if we miss it, we miss it. It's okay. Because the short end is still paying 5%, and it's probably going to be that way for a little while. It's going to be that way until we have a bigger accident, I think, in the market.
Okay. All right. Well, Mike, we're with you just real quick, 60 seconds or so. Anything you want to say about gold? Because it did climb back above $2,500 an ounce 2 days ago. It's now a little bit below that. But I know it's something you track very closely. Are you seeing much in this action that makes you think it's highly likely to get ahead in one direction or another?
The gold chart looks beautiful. It has for months, if not years, and as you said, we just touched 2,500 in the futures market. I might
Yes.
add, we touched it in the futures market. We haven't quite touched it in the spot market. We were like 2470. I'm taking a look at a chart of copper right now. Copper is somewhat correlated to gold and silver. Both copper and silver have been disappointing. I'd be happy to share some of these charts if you want. I'm not sure that we need to. Silver went to 3250, fell down to around 27 or so. It's 15% pullback. Copper, I'm seeing here at around the same time a couple months ago, touched 5.2, and it's trading right now right around 4. So copper went from 5 to 4. It's probably going higher. If we're right about gold and silver, copper too looks technically strong here and should go up to 5 to 6 again. Silver should head towards 35, but gold has been the star of it all, sitting here at 2470. What's keeping it from breaking through? I don't know. I think that I will bring up just that quickly, that chart of gold, so we can close with that. I think if you got to think of one thing and just focus on it, I'd say keep it simple and be patient and just wait for that chart to really break out. So here's the chart of gold. This is GLD. This is an ETF. But the shape of the chart is the same. And here's a daily chart going back many months. We've had this line in the sand here. This is equivalent to around 2,500. This line that I have here on the chart, actually, I'll put a line there to make it a little bit clearer. But right there, my line is right around 2,500. We've been touching that over and over again. So we have yet to push through that resistance. I think that's coming soon. I don't know exactly what the catalyst will be. But if we go out further to the week or the month chart, here's a weekly chart of gold. It's been dealing with this level for almost a year. And let's go to a monthly chart, and you just see how big this breakout was 6 months ago. This is a 20-year chart with a 13-year consolidation and then a massive breakout. So it's going higher in our view. 2,500 to 3,000 should be the new range. What's going on with silver, though? Let's take a quick look at silver just to kind of close the loop there. Here's a daily chart of silver. It hit this high, which is equivalent to 3250 in spot, and it's been just dragging in this flag here. So I don't know why silver is underperforming. Let me go to the weekly chart. There's this kind of down flag, but we haven't broken out. All I can say about silver is that it moves fast and violently. Take a look at some of these weeks back here. So if gold breaks through this 2,500 level convincingly, we could see a bar. Like, take a look at this. This is equivalent to a $3 up move in silver in 1 week. We could have one like that, and it brings us right up to the top of the range. So I would just keep your eye on gold. Gold is sitting right there, knocking on the ceiling of 2,500. When that breaks through, silver should go higher. You should even see copper go higher. So the metals are relatively correlated together, and they represent a good opportunity, I think, and the companies that mine them.
Yeah, Adam, if I could just chime in on piggyback on Mike there, the gold mining stocks, which our clients know we have an allocation to, have been quite strong. And bringing it back to your conversation with John Pease from GMO, this is what we have considered the classic deep value type of sector, right? He spoke broadly about deep value as a kind of investment. The gold mining stocks have traded at significant discounts to historical value, even if just measured by comparison to the price of gold itself. Now, there are complicating factors. The cost of production has increased for a lot of these companies. The geopolitical risk has increased, but still the valuations have been very compelling. And we think we've seen the early innings of that valuation discount gap start to close. Just a little anecdote, just a few days ago, Gold Fields, a large, I think, South African gold miner, announced the acquisition of Cisco Mining at over 50% premium to the prior day's closing price for Cisco. So there seems to be talk about insiders voting with their feet in terms of pounding the table that valuations are compelling, even if costs have risen over the last decade. That's a pretty interesting anecdote. We've had some pretty encouraging reports from large miners like Barrick Gold recently. So we've seen a good run there, and we'll probably look for some further strength to reallocate, take some of our oversized allocations down to a more model weight. But that's the kind of deep value sector that we have been allegiant to, and it can be frustrating. And John Pease talked about this. Deep value doesn't always work out right away, but it over time, those valuation discounts tend to close.
Right. Well, that's why I really like it, because you have math on your side, right? You've got reversion to the mean. All right. It's a great way to bring it full circle here, John. So we'll wrap it up on that. Folks, if you really enjoyed having John Pease from GMO on the program, would like to see him come back on, and maybe some of his other colleagues from GMO appear here on the channel from time to time, please let us know by hitting the like button and then clicking the red subscribe button below, as well as that little bell icon right next to it. If you are looking for ways to put the approach that John Pease talked about into practice in your portfolio, if you'd like some help with that, highly recommend that you do so following the guidance of a good financial advisor who understands the approach that GMO follows. Obviously, the guys at New Harbor do that. So if you've got a good financial advisor who can do that for you, great. Work with your existing advisor. But if you don't, and you'd like a conversation, or maybe bounce some ideas off of an advisor that does, maybe even John and Mike and their team there at New Harbor, then fill out the short form at thoughtfulmoney.com. And schedule a free consultation with them. And again, these consultations are totally free. There's no commitment to work with these guys. It's just a free public service they offer to try to help as many people as possible, position as prudently as possible for the future that they think is likeliest ahead. John and Mike, thanks so much, guys. Another great week. Thanks for keeping us informed on a week-to-week basis here about what you see going on in the markets, and being so transparent about how you are thinking through any potential changes that you're making in your portfolio. That's exactly what I want the audience here to get from you guys. As we wrap up, John, maybe I'll give you just a last quick moment to opine. What are you guys hearing right now from the general vibe of the people that are reaching out and having conversations with you, whether they're existing clients or whether they're just people that are filling out the consultation form? What is sort of the big themes that you're hearing right now from the average investor?
Yeah, I think the common thread there, Adam, both with some of our clients as well as the folks, prospective clients that we're talking to or just giving some free consultative time to, is the last few weeks have rattled some folks. They got a bit rattled and concerned, and I think the market action kind of played that out. I shared that Ned Davis chart that showed really record drop in sentiment. That the emotions are on a pin top right now. They're very susceptible to swing both ways. So that's very classically what you see at major market tops. People get really nervous, yet they feel paralyzed, and a lot of the tone of our conversations are of that sort. So we've been very busy. Hopefully in what we see as a productive way, because it ultimately gives us a chance to bring people back down to the data. It is not a time to panic, but it is a time to be very disciplined and cognizant of where we likely are in the cycle.
Great. And we've talked in the past, John, about how taking losses in investing, you go through the Kubler-Ross 5 stages of grief. Right. The first is denial. You can't believe it's happening. I can't remember which step it is, but one of them is bargaining, right? Where you just start basically making your bargain with God, which is just please get the price back up to where I was, and I promise I'll sell out. Right. And, investors, you just talked about how the S&P has jumped 6% since that washout day that we had a little over a week ago. It's kind of like, hey, your prayer got answered here. Right. So you should honor that and do whatever you were promising God you were going to do when that happened, right? So at a higher level, it's look, if the market shudder that we had there made you realize that you weren't that you were vulnerable in some way, shape, or form in your portfolio allocation in a way that you did not want to be, use that as a strong sign from the universe to take action today to shore up whatever those vulnerabilities are, so that if indeed the market has rockier times ahead, you've taken the prudent steps beforehand and are sitting in the catbird seat and feeling much better, and not having your financial prospects or just your mental health, damaged by whatever the market might be doing. All right, John, Mike, thanks so much, guys. Really appreciate you being here this week again. Super fun to have a representative from GMO here. I hope we have more in the future. And whatever happens between now and next week, I'm going to thank you in advance for coming here and making sense of it for folks. Everybody else, thanks so much for watching.